We've just witnessed a turning point in British political history, with the curtain falling on 14 years of Conservative rule. As Keir Starmer becomes just the 7th Labour Prime Minister and only the 3rd since the 1970s, clients are asking us what the new government will mean for the economy, for taxes, and for their investments. In this video, I'll try to provide some answers, touching on policy, the government bond market, and UK stocks. It's not quite a case of things can only get better, and I'll flag risks along the way, but overall, I hope my message is a broadly reassuring one. An obvious place to start is fiscal policy, tax and spending. On the campaign trail, both major parties kept their cards close to their chests about the specifics here. Independent experts, like those at the Institute for Fiscal Studies, accused them of leaving voters guessing. Labour's manifesto made some broad commitments. It pledged no return to austerity, and it promised to prioritise public services, which are under severe pressure across the board, from hospital waiting lists to holes in the roads. Rachel Reeves is inheriting spending plans from the current government, which contain significant cuts to important departments. The health service and defence may be protected, but important areas like justice and local government in principle face reductions of more than 2% a year, austerity 2.0 in other words. The new Chancellor will want to avoid these cuts, but her room for manoeuvre is limited. She's pledged not to increase the 4 taxes which raise the most revenue. These are income tax, national insurance, VAT and corporation tax. And she's pledged to stick with fiscal rules, which in theory limit her ability to borrow. Her challenge is to square this circle, delivering promised improvements to public services within those tight constraints. One way of doing this is to raise taxes which weren't explicitly frozen in Labour's manifesto. The biggest revenue raisers in this category include capital gains and inheritance tax. It's possible we'll see changes there, alongside the changes already announced to private school fees and non-dom status. For our clients, potential changes to the taxation of capital gains and inheritance are one of those risks that I flagged at the start. Our financial planning team have explored this issue in more detail in an article which you can find on our website, and there's a link with this video too. Another possibility for Rachel Reeves is to find flexibility in the fiscal rules. That could include technical changes like altering how public debt held by the Bank of England is counted. It could also include taking a leaf out of Gordon Brown's playbook. This means investing in partnership with the private sector to keep spending off the public sector balance sheet. Both would allow the government to borrow a bit more while still abiding by the letter of the fiscal rules. If the new government does indeed decide to use this flexibility to borrow more, the key question is how the government bond market would react. Now, the shadow of Liz Truss looms long over discussions of this topic, but what we're talking about here is really quite different to that mini-budget debacle. To simplify what's a very complex issue, it matters enormously what borrowing is used for. Borrowing to invest in public services which underpin the economy is likely to be far more palatable to markets than the tax cuts for the well-off promised by Truss, which most empirical evidence suggests would have done little for economic growth. We saw in the 2010s that cutting public services aggressively can be a false economy. Because those cuts hurt growth, they ultimately make it harder, not easier, for the government to service its debts, so avoiding a rerun of austerity would be a good thing. Now, making changes to the fiscal rules might sound too clever by half, but it happens remarkably often and markets take it in their stride. The rules are now in their 10th iteration since 1997. Tweaking them would be one thing. Abandoning independent scrutiny of policy altogether, a la Liz Truss, is something else altogether, and is not on the table now. Labour's clearly affirmed its commitment to scrutiny from the Independent Office for Budgetary Responsibility, and it plans to enshrine that in law. It's also worth saying that the context has changed a huge amount too. Rachel Reeves moves into number 11 with inflation back at 2%, and the Bank of England poised to cut interest rates in the next few months. The contrast couldn't really be greater to Truss's tenure when inflation was above 10% and central banks around the world were raising interest rates aggressively. With all of that in mind, we're still comfortable holding UK government bonds. A little more borrowing than the current fiscal plans imply shouldn't be a big problem for them, and the global context is turning more favourable. Now, what about the stock market? With the radical pledges of the Corbyn era long gone, there's not too much for companies to fear from Labour's regulatory agenda. While it intends to nationalise rail providers, this has already begun to happen under the Conservatives anyway. and the only other pledge of note in this area is the commitment to a new state-owned energy supplier called GB Energy. Meanwhile, the planned changes to labour laws have been watered down. We will need to watch carefully how the minimum wage changes though. Labour's manifesto was vague on this point, and it matters a lot for low-paying sectors like retail. Otherwise, it's possible that policy stability could be a good thing for the stock market and for investment in the UK generally. In the period of turmoil that followed the 2016 Brexit vote, we saw investment in the UK lag its peers and the stock market trade at a large discount to other advanced economies. International investors turned away from the UK, and it's hardly surprising given the constant policy churn we've seen since then. Long-term investment thrives on certainty, but we've had 7 chancellors in 9 years and wild swings in policy direction. Mere stability would probably be an improvement, both on the domestic front and in relations with the EU. There are also 2 other areas where there's a broad consensus that the UK could do better to catalyse investment. The previous government intended to make changes in both cases, but it lacked the bandwidth or political capital to get them across the line. Specifically, I'd expect to see the new government legislate to encourage pension funds to invest in UK equities. A variety of legal changes since the 1990s have discouraged them from holding stocks, but it's now widely acknowledged that this has been a mistake. We could see things like new vehicles to make it easier for them to invest in smaller UK companies. Another area is the planning system. There's broad agreement that the UK has a very idiosyncratic and slow system, and this makes building infrastructure here far more expensive than in our peers with simpler rule-based systems. Just think of the 40+ legal challenges that High Speed 2 has faced, for example. This planning system throws sand in the gears of investment more generally, not to mention making it hard for homes to be built where they're needed. I'd expect to see change here soon too. That could be a positive for investment and growth in the UK. Now, these changes aren't silver bullets. They won't transform the outlook for the market overnight. But they do give us some reason to be positive despite the tax changes that I mentioned earlier. We've talked before about the valuation of the UK stock market, how it looks low compared to markets like the US, for example. These changes help to address some of the causes of that low valuation, and we remain relatively optimistic about the prospects for UK-listed stocks. So where does this all leave us? There are several things to be encouraged about from an investor's point of view. The return of policy stability, along with pension and planning reform, could provide much-needed support to investment in the UK after years of weakness. The bar has been set low by the turmoil we've seen since 2016. In the meantime, the radical regulatory agenda of Jeremy Corbyn's Labour Party has been almost entirely abandoned too. And the global economic backdrop has become more favourable in the meantime, with interest rates starting to fall. But we should be aware of the risks at the same time. The Chancellor is inheriting a tough fiscal situation, with public services in need of investment, from schools and hospitals to roads and prisons. Labour's manifesto was light on detail about precisely how it would deal with this bind. Rachel Reeves may be tempted to increase capital gains and inheritance tax to plug some of the gap, given her commitments not to raise other taxes. Overdoing this risks doing more harm than good, working against the positive changes designed to attract capital to the UK elsewhere. And there are other areas where the vagueness of Labour's manifesto creates similar risks. Workers' rights are one such issue. We still don't know for sure how far the party will push the changes it's proposing, particularly to minimum wage setting. You can read much more about everything election-related in our latest quarterly Investment Insights magazine, which includes all the detail on other areas, including Labour's policy for the environment and a look ahead to the US election too. Thanks very much for listening. I'm Oliver Jones, Head of Asset Allocation at Rathbones Investment Management.